Welcome to The Explainer. It's one of those things that when you stop and think about it is kind of wild. For more than 30 years, there's been this massive, unstoppable river of money flowing from Europe to the United States. And today, we're going to dig in and find out why. We're going to look past the easy answers and uncover the powerful, often hidden forces that are really in control.
Okay, so if you took an Economics 101 class, you probably learned the simple rule. Money chases the highest interest rates. Simple enough, right? Well, the reality for the last 3.5 decades tells a much, much bigger story. It's really this complex dance between a hunger for growth, a desperate search for safety, and the unmatched, almost magnetic pull of the American financial system.
To really wrap our heads around this, you gotta know that international money travels in three very different ways. First, you've got foreign direct investment, or FDI. Think of this as the sticky capital. It's the long-term, committed money going into things like building factories or buying companies. Then you have portfolio flows. This is the fast money, the stuff that zips in and out of stocks and bonds in the blink of an eye. And finally, there are bank flows. This is the cross-border lending that, as we've seen, can get pretty dicey and reverse course in a panic.
All right, so let's rewind the clock a bit. We're going to start back in the 1990s because this was the period that really set the stage for everything that came after. This is when the U.S. became this incredible financial center of gravity, pulling in capital for reasons that went way, way beyond just simple interest rates.
And just to give you a sense of the sheer scale we're talking about here, just look at this number. By the end of 2024, European investors are on track to hold over 12 trillion euros in U.S. assets. That's an 83% jump in less than a decade. I mean, this isn't just some small trend. It's a fundamental pillar of the entire global financial system. So here's the big question, right? If it wasn't always higher interest rates pulling all that money across the Atlantic, then what was it? What was this magnetic force that made the U.S. so irresistible for investors?
Well, it really boiled down to four main things. First, you had the incredible growth story of the 90s tech boom. Everyone wanted a piece of that action. Second, America's markets were just so deep and liquid. You could buy or sell massive amounts of stocks or bonds without moving the price, and that's a huge deal for big investors. Third, the US dollar is the world's reserve currency, which gives it this massive built-in advantage. And finally, there was this phenomenon economists called the global savings glut. Basically, trillions of dollars from countries like China and oil exporters, all looking for a safe, reliable place to park their cash. And the default answer? It was always the US.
Okay, so that was the boom time. But then, 2008 happened, and the music stopped. But here's the truly strange part. A crisis that literally started in the United States didn't push money away from it. No, instead it actually accelerated the flow towards it, completely rewriting the rules of global finance.
The world was hit by this brutal 1-2 punch. First, you had the global financial crisis in 2008, and right on its heels came Europe's sovereign debt crisis, where whole countries looked like they might default. This wasn't just a market downturn. This was pure, unadulterated panic, where it felt like the entire system could just come crashing down. And in that moment of sheer panic, the entire mindset of investors just flipped. The question wasn't, how can I make the most money? Not at all. It was, where is my money going to be safe? The whole game switched from chasing yield to pure, simple survival.
And this brings us to the great paradox of the whole crisis. Even though the fire literally started in the American financial house, money didn't flee from the US, it fled to it. Why? Well, because when everything feels like it's collapsing, the US Treasury market is seen as the safest, most liquid place on the entire planet to hide your money.
So, after the chaos of the crisis, once the dust kind of settled, the world's central banks decided to try something pretty radical. And for the first time, it gave us this perfect real-world test of that old textbook theory. Does money really just follow higher interest rates?
And here's what happened. You had the U.S. Federal Reserve, and they started to slowly, carefully raise interest rates back toward normal. But in Europe, the central bank went in the complete opposite direction. I mean, they went way the other way, pushing rates into negative territory. You literally had to pay to keep your money in some banks. It created this huge, sustained gap between the two.
And the result was pretty dramatic. I mean, think about it. If you're a European investor and you're getting paid negative interest at home, the US, with its positive rates, suddenly looks incredibly attractive. Capital just poured across the Atlantic.
It got to the point where a staggering 60% of all the foreign stocks held by Europeans were American stocks. For once, the textbook theory was playing out perfectly.
So, okay, let's just take a step back here. We've got three totally different eras, driven by three totally different things. First growth, then fear, then a simple rate gap. So what's the common thread? What's the ultimate force that's really directing this river of money?
Just look at this pattern. It's kind of amazing, isn't it? Late 1990s, the story was growth. Money flows to the U.S. 2008 crisis, the story was fear. Money flows to the U.S. Mid-2010s, it was about the interest rate gap. And money flows, you guessed it, to the U.S. The reasons kept changing, but the destination never did. And that tells you there's a much deeper force at work here.
And that deeper force is something called structural asymmetry. It's a bit of a mouthful, but it's a huge idea. It basically means there's a fundamental imbalance baked into the very architecture of the global financial system. The combination of the U.S. market's massive size, how easy it is to use, and the dollar's role as the world's default currency, it all creates a kind of financial gravity that's almost impossible to escape.
So, in the end, what's the bottom line? Yes, of course interest rates matter. They can absolutely change the speed of the current, but they are not the river itself. That powerful westward flow is carved into the globe by the unique and utterly dominant role the United States plays in the world economy.
And that brings us to the final critical question, doesn't it? This powerful, decades-long pattern has defined the modern financial world. But as the global landscape shifts, as new powers rise, can we assume this fundamental asymmetry will hold forever? For the next 35 years, will that river of money still flow west?